In 2009, the United States was in the worst economic recession in 80 years. Unemployment hit 10%. Banks were failing. The housing market had collapsed. GDP was contracting, and the stock market went up 70%. How is that possible? How can the stock market rally during an economic catastrophe? The answer reveals one of the most important and misunderstood ideas in all of investing. The economy and the stock market measure completely different things. The economy measures what is happening right now. GDP, employment, consumer spending, business output. It is a record of the present, and it changes slowly. The stock market measures what investors expect to happen in the future, specifically the next 6 to 18 months. It is not a reflection of today. It is a bet on tomorrow. This single distinction explains nearly every time the market and the economy seem to contradict each other. Investors look at a company and ask, what will it earn in 3 to 5 or 10 years? They estimate those future earnings, then discount them back to what they are worth in today's money, accounting for time and risk. The current stock price is the market's collective answer to that question, updated in real time as new information arrives. When the economy looks bad but investors believe it will improve, they bid prices higher today because they are buying future earnings, not current ones. When the economy looks strong but investors fear it will weaken, they sell today because the future they are pricing looks less bright. The economy tells you what is, the market tells you what investors expect will be. Let me walk through 2009 in more detail because it is the clearest example of this principle in modern history. In March 2009, the S&P 500 hit its lowest point. Unemployment was near 10%. Major banks had required government bailouts. GDP had contracted sharply. Then the market started climbing. By December 2009, the S&P 500 was up 70% from its low. The economy was still contracting. Why did the market climb? Because investors saw the Federal Reserve's emergency response. They saw the government stimulus. They saw early signs that the financial system would stabilize, and they began pricing a recovery before that recovery had actually arrived. The market did not ignore the recession. It looked through it to the other side. 2009 is not an anomaly. Here is how often this happens. In 1987, the Dow Jones fell 22% in a single day, Black Monday. The economy, it kept growing. There was no recession. The crash was caused by portfolio insurance strategies, not economic weakness. In 1999 and 2000, technology stocks soared to extraordinary valuations, many with zero revenue. The economy was genuinely strong, but the market had dramatically overpriced future earnings that never materialized. In 2020, the market fell 34% in 33 days during the COVID lockdowns, then recovered fully in 6 months while the broader economy took 2 years to recover. In 2022, the market fell 25%. The economy grew. No recession occurred. The crash was driven by interest rate fears, not economic reality. The pattern is consistent. The market and the economy are not the same thing. If it is not the economy, what actually moves markets? 4 things drive the vast majority of market movements. First, earnings expectations, forward price to earnings ratios. What investors will pay for future earnings, expand and contract based on sentiment and growth expectations. Second, interest rates. When rates rise, future earnings are worth less in today's money. This is why rising rates often push markets down, even during economic strength. Third, economic surprises. This is crucial. Markets do not react to whether economic data is good or bad. They react to whether it is better or worse than expected. A good jobs report that misses expectations can send markets lower. Fourth, sentiment and fund flows. Fear, greed, and where large institutional investors are moving money all affect prices in the short run. 4 practical implications for your investing. 1. Do not panic sell during recessions. By the time a recession is officially confirmed and headlined everywhere, the market has often already priced it in or even begun recovering. Panic selling locks in losses at exactly the wrong moment. 2. Do not chase markets during economic booms. A strong economy does not guarantee strong future returns. If earnings expectations are already priced in at high valuations, the forward returns may be poor. 3. Watch forward guidance, not current headlines. Federal Reserve signals, company earnings forecasts, and leading economic indicators move markets far more than current GDP numbers. 4. Stay invested across cycles. Time in the market consistently beats timing the market. Investors who remained invested through every recession since 1950 outperformed those who tried to exit and re-enter based on economic conditions. 4 things to remember from this video. 1. Markets price the future, not the present. Stock prices reflect what investors expect earnings to be, not what the economy is doing today. 2. Divergence is completely normal. Markets and the economy can move in opposite directions for months or even years. This is not a malfunction, it is the design. 3. Surprises move prices. Markets do not react to good or bad news. They react to better or worse than expected. The expectation is already in the price. 4. Stay the course. Long-term investors who remain invested across economic cycles consistently outperform those who try to time the market based on economic news. Next time you hear someone say the market is disconnected from reality, you will know exactly why it appears that way. The market is not ignoring the economy. It is looking past it. If this video helped you, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. Wednesday we are covering tax loss harvesting. How smart investors turn their investment losses into real, bankable tax savings. It is one of the most underused strategies in personal finance, and it is completely legal. See you Wednesday.